Hey guys, this is Andre. Hope you are all doing well. In this video, we'll talk about options in the context of financial markets. Please take a minute to read our disclaimer, and if you agree with all the terms and conditions, let's go. By the end of this video, you'll hopefully be able to understand more about what options are, how people use them to make money or any other means the options can be used for, and also the most important characteristics of all the options. So we'll go ahead and start this video with the simple definition. What are options? Options are a derivative. Their value comes from some other asset which is closely related to the option, and from now on we'll call this asset the underlying asset. Options can be based on stock, commodities, future contracts, real estate contracts, business contracts, and so on. But in this video we'll be mostly focused on stock options. If you think about it, since their value comes from a different asset, options used to be just a piece of paper. Nowadays they are just some bytes in some database. One could say that by themselves they have no intrinsic value. But options are tradable in the secondary market, and many people are able to profit from buying and selling options. But in reality, what they are trading is volatility and risk. People who deal with options are ultimately at some level dealing with market volatility and risk. And the best way to understand what options are is to keep in mind three things. First, there is the underlying price versus time chart. So the underlying that the option derivates from has its own price through time. Now, the options price also varies through time, and this is also one of the possible charts we can find. But we can also find a different chart, which is often shown in explaining option strategies. And this chart is the option profit loss versus the underlying price. Observe that time is not present in this third chart. So we have to keep in mind that the underlying has its own price variation through time. The option has its own price variation through time as well. But most of the time when we are trading options, what we are interested in is the profit loss of this whole strategy versus the underlying price. Now, before going any further, I will illustrate this concept with two different examples. The first one, imagine that you're looking for a house and you found this $100,000 house today in a good neighborhood, but you're not really sure if you want to commit. Maybe you want to look further into different houses, or maybe you want to get a feeling of the real estate market in the area before buying the house. So what do? You talk to the real estate broker, and then he offers you an option to buy the house within 3 months for the same price as it is today, or $100,000. And this option costs $3,000. If you want to have this option to buy the house for $100,000 in 3 months, no matter what happens to the real estate market in the area, you have to pay the real estate broker $3,000. And say you decide to purchase this option. What is going to happen in the real estate market during 3 months? Three things can happen. 1, the price of the house can go up. 2, the price of the house can remain stable. And 3, the price of the house can go down. And how does the option work in these scenarios? So if the house of the price goes up in 3 months, you can still buy it for $100,000 no matter what the price of the house is. If it's $150,000 to $100,000, it doesn't matter, because you have this option to buy the house for $100,000 within 3 months, no matter what is the current market price of the house. In the second scenario, if the house price goes down, you still have the option to buy the house for $100,000. But now, after 3 months, the market price of the house is say only $80,000. So why would you buy it for $100,000 in the first place? In this case, you don't need to use the option. In this case, if you actually exercise the option, you would be paying more than the market price. So the option is useless for you if the price of the house goes down. If the price of the house remains stable, it doesn't matter. You can buy it at market price. You can buy it using your option because you pay the same amount in the end. But 3 months ago, you have already paid the $3,000 to the real estate broker to secure the $100,000 cost. So this money will never come back to you. Now, in the scenario where the price of the house goes up, but you end up deciding that you don't want to buy the house anymore, you can still sell your option within these 3 months to someone else that might be interested in buying the house for $100,000. So in this example, the option gives the person who is buying the house the right, but not the obligation to buy the house for $100,000 in a period of 3 months. And on the other hand, the person who wrote the option, the real estate broker, must sell the house if the option is exercised. This chart here is the profit-loss chart of our house option. The vertical line at 100 is the option's strike price. This is the price at which the real estate broker committed to sell the house to the buyer within 3 months. And on the x-axis, we have different possible values for the house price. And on the y-axis, we have the profit-loss of both the person who is buying the house as the blue line and the home broker agent as the orange line. So we can see here that there are pretty much mirror images from each other. The person who is buying the house starts with a $3,000 loss because he has paid this premium for the option to buy the house. And say that the person is committed to buy the house. So if within 3 months the market price of the house is $103,000, this option strategy broke even to the buyer because he will be able to pay $100,000, but he has already paid a $3,000 premium. If the market price of the house goes beyond $103,000 to $105,000 or $110,000 or even further, then the buyer will have a profit in this strategy because he will pay only $100,000 for the house plus the $3,000 premium he already paid for the option. And on the other hand, the seller of the option, the real estate agent, starts with a $3,000 profit. And as the market price of the house goes up, he starts to lose money in this strategy because he would be able to sell the house at a higher market price if he hadn't written this option. The second example, let's say we are farmers and we produce oranges, and currently the price of the kilogram of orange is $10 per kilogram. We don't know what's going to happen with the orange market in the future. We don't know if this price will go up or down, but it seems really high. So we talk with these orange distributors and people who will sell the oranges or make juice or whatever, and they offer us an option to sell the oranges at $9 per kilogram in 3 months. And this option will cost us $2 per kilogram of oranges. Now say we decide to buy this option to sell our oranges for 9 kilograms in 3 months, even though the current price is $10 a kilogram, but we expect the market price of oranges to go down in the future. So again, 3 different scenarios for the orange market price. The price can go up, the price can go down, or the price can remain stable. If the orange price goes up, we will be able to sell the orange at market price, which will be more than 9. So we don't have to use the option and it expires worthless. It will have no value whatsoever in 3 months. The premium we paid for it 3 months ago will be somewhat for nothing, but not definitely for nothing because we were trying to protect ourselves and protect our oranges. Now, if the orange price goes down as we expected, say the orange price is now only $2 per kilogram, we will still be able to sell all of our oranges for $9 a kilogram, thanks for the options we purchased 3 months ago. And in this case, the option gives us the right, but not the obligation to sell the oranges for $9 a kilogram in 3 months. And on the other hand, the orange distributor, the person who wrote the option, must buy the farmer's oranges if our option is exercised. And this chart here, again a profit loss by underlying price, show us what does this option strategy looks like for us. And the series are the same. The dotted vertical line is the option strike price, the blue line is the buyer perspective, and the orange line is the seller perspective. So blue is farmer and orange is orange distributor. Now the current market price is 10 and our options strike price is 9. So until the orange market price reaches 9, we, the buyer, the farmer, are at a $2 per kilogram loss because we had to pay this premium for our option. If in 3 months the market price is above $9, we still have this $2 loss per kilogram because we can just sell our oranges at market price and we will not need to exercise these options. But as the orange market price goes down below 9 and all the way to 2 or 3, then we will be able to profit from this strategy because our option gives us the right but not the obligation to sell all our oranges for $9 a kilogram. And on the other hand, the orange distributors, the option writers, start with a profit of $2 per kilogram because the current market price of oranges is 10. And if the market price of oranges stays above 9, this is all the profit they get from this option strategy. But as the market price of oranges start to go down below 9, then they start to have a loss in the strategy because if the options are exercised, the orange distributors are obliged to buy the oranges for $9 a kilogram, even if the market price is, say, $6 a kilogram. And from these two examples, we can get the following information about options. First, there are two kinds of options. One is called call, which gives the right but not the obligation to buy the underlying asset at some predetermined time for some predetermined price. This call option was used in the house example. And there is also the put option, which gives us the rights, not the obligation, to sell something at some time for some predetermined price. And this put option was similar to the orange farmer example. And there are long and short positions. There are always two sides of the same coin. So someone is buying option and someone is selling or writing them. And the seller or writer, if exercised, has the obligation to live up to the contract and deliver. So when we buy options, we have the right but not the obligation. But when we sell options, we have the obligation if we are exercised. And this might sound a little confusing for now, but from the market point of view, we have 4 different combinations, right? Long call and put and short call and put. So short calls are somewhat equivalent to long puts, while short puts are somewhat equivalent to long calls. But from the dirty point of view, when we are long, we have the right, and when we are short, we have the obligation. So this gives us a total of 4 combinations for option strategies, and this is what makes option strategies a little bit more complex than a regular stock or other asset strategies. But don't worry, once we grasp the basic concepts, everything will be easier. Now let me list you guys the main option properties. First one is the option type, which can be either American or European. American options can be exercised any day until their expiration date, whereas European options can be only exercised on the expiration date. The expiration date, sometimes referred to as maturity, is the day in which the options will expire. They will not be good for anything anymore. The strike price of the option is the underlying price right you get to either buy or sell the underlying. Now, the underlying asset is whatever the option is based on. So it may be some stock, it may be some commodity, it may be some future contract. And then there is also the option price, how much we have to pay for this option, also known as premium. And finally, the lot size, how many options we purchase and how much of the underlying asset these options give us the right to either buy or sell. When we start to think about our option strategies, we have to consider all of these properties in order to make sure we are doing the right thing. Now, what do people use options for? Sometimes, as in the case of the orange farmer, they will use options to hedge their assets. Or in the case of the home buyer, they use it as a cheaper surrogate for the underlying instrument. And as the real estate broker and the orange distributors, people can use options as additional income streams by collecting the premium in selling those options. Keep in mind that this list is very short because those are just the general areas. There are numerous applications in each of these areas. And how do people price options? Well, on one hand, the market will price the options themselves, because if someone is selling at some price but no one is buying at that price, then this person will either have to settle with not selling the option or will have to drop the price. But on the other hand, there are some other factors that people will consider in order to make their initial ask. So first, there are some mathematical models, mainly the Black-Scholes model, that helps calculating the price of European options. There is also a different pricing strategy based on the Greeks, which are delta, gamma, vega, and theta. But these models are kind of complex and are beyond the scope of this introductory video. So I'll go ahead and simplify the option pricing for you guys to only 3 variables. So first, we have the time to expiration, or what people call time decay, and related to theta. Think about it. The longer you have to your option to expire, the more things can happen with the underlying price, with the general market. So the longer the time to expiration, the more costly is the option. And something that people say a lot, time decay corrodes the value of option. The more the time passes, the less valuable it is, because the closer it is to expiration and the less time you have for something to happen. The second variable is market volatility, or also called as implied volatility, and has to do with vega. The more volatile the market currently is, the pricier your options will be, because no one knows what's going to happen. So a lot of people are betting on that volatility or are trying to hedge themselves. And finally, the difference between the current underlying stock price versus the option strike price, which has to do with delta and gamma. Now we'll see this aspect later in more detail, but as you can imagine, the closer the underlying stock price is to the strike price, the more expensive the option is. And the farther the underlying stock price is from the strike price, the cheaper the option is. These 3 variables pretty much determine how much an option can be sold for. But remember that sometimes the market is irrational and maybe someone will be willing to pay an extra premium to get those options. Or sometimes you can find pretty cheap options which you would expect to be much more expensive at that point. And now I will show you guys some definitions and financial lingo which people use when trading and using options. So first, there are numerous option strategies. You might have heard about condor, butterfly, strangle, straddle, spread, collar, and so on. Maybe a combination of these strategies, maybe something like iron butterfly, and all that makes options seem so complicated. But the truth is, if you understand the basic concepts of options, what are call, what are puts, what are their main characteristics, and the fact that there are three different charts possible for options. The first one is the underlying asset price versus time. The second one is the option price versus time. Is related to the option strategy itself. So it's the profit or loss of the option strategy versus the underlying asset price. And keep in mind that this third one does not involve time. You are already familiar with it from those two figures I showed before. When we are dealing with option strategies, whatever the strategy is, whatever its name is, this chart is very important because it will show you how much profit you can make, how much loss we will have in the worst case scenario, and what is the probability of your strategy working. So it's through this chart that people will do risk and profit analysis in option strategies. And this chart is also referred to as hockey stick chart. This figure here was extracted from wikipedia.com, and it shows the chart of a long call. So as you remember, a call is an option that gives us the right to buy the underlying asset at some point in time and for some fixed amount, the strike price. So here we have the vertical line as the strike price. And we have the profit line and also the payoff line. The payoff line indicates when the option strategy starts to yield some profit. But the profit line is the real profit because we have to pay the premium for this long call when we are buying this option. The y-axis is the profit or loss, and the x-axis is the underlying asset price at maturity. Here it says share price because it's related to a stock option. So this is our third kind of chart, the one that is kind of independent from time. Remember that simultaneously we have to analyze two other different charts, which are the share price by time and the stock price by time. These two are related to the market, and this third one is related to the profit prospect of our current option strategy. Now remember when we were talking about option pricing, I would come back to the difference between the underlying and the strike price. So this is what people call moneyness. And options can be either out of the money, OTM, at the money, ATM, or in the money, ITM. And this gets much easier to see in this chart, so let's go back to it. So when an option is out of the money, it means that the underlying price is currently below the option strike price. So out of the money would be all this area here on the left side of the chart. Now, when an option is at the money, it means that the underlying market price is pretty close to the option strike price. And when an option is in the money, as you might have guessed, it means that the current underlying market price is above the option strike price. And how does this affect pricing? For example, when do you think this option would be more expensive? When it's out of the money, at the money, or in the money? So think about it this way. The call option gives you the right but not the obligation to buy this underlying asset at the strike price. So if the current underlying market price is above the strike price, the option will be more expensive because you can actually buy it below the market price. Now, if the current underlying market price is below the strike price, or if the option is out of the money, this option will be less expensive or even really cheap because there is no point in buying this option if you can buy the stock at market price. I've used this expression several times before, but what does short and long actually mean? To short or open a short position means to sell an asset you don't currently own. And to long an asset or open a long position means to buy an asset. And this has a lot to do with your perception of the market. So if you have a bearish view of the market, if you believe that stock prices are currently too high, and the stock market is due to a correction, you will more likely open a short position. You will want to sell something at a certain price that you believe is too high, and then you will buy it back at a lower price. You will close your position and you will profit from this trade. And on the other hand, if you have a bullish view of the market, if you believe that the prices are really low and the market is due to a price increase in the short future, you will be more likely to open a long position. So you will buy something that you believe is cheap right now, so you can sell it in the future for a higher price, and you will close your position and you will score some profit from this trade. Now, how does it affect options? Remember that we also have two kinds of options: calls that give us the right to buy something at a certain time, and puts that give us the right to sell something at a certain point. But these terms are already related to long positions. So long calls give us the right to buy something. But we also have the opposite side of the strategy. We can also short call, and in this case we have a bearish view of the market. And on the other hand, long puts are bearish, whereas short puts are bullish. If you still remember our illustrative examples, in the first one we bought an option to buy a house at 100k for 3k. So we believe that real estate market would go up. We believe that the house would be worth more than 100k in 3 months. So we had a bullish view of the market, whereas the real estate broker had a bearish view of the market. He believed that the real estate prices would go down and he would be able to profit from selling us that option. And in the second example, we purchased that option to sell oranges for 9 a kilogram because we believed that the prices were too high at then and there would be a correction and prices would go down. So we had a bearish view of the market. Whereas on the other hand, the orange distributors had this bullish view of the market. They believed that the orange prices would go even higher, and they were happy to sell us that put option to buy our oranges for 9 because they believed that the prices would go up. So as you can see, we have 4 different combinations. And coming back to that Wikipedia chart I showed you a few minutes ago, in the upper right we have how a long call works and how we profit for it. If we want to know how the short call works and how the option writer profit for it, all we have to do is flip the chart vertically and we get the chart in the bottom part of the slide. On one hand, the long position starts at a loss because we have to pay the premium, and we will only start to profit after the underlying price goes beyond the strike price. And on the other hand, the seller, the person who opened that short position, starts at a profit because they were able to collect this premium first, and then they will start to have a loss if the underlying asset's market price goes above the strike price. And why would they have a loss? Because if they hadn't sold this option, they would be able to sell the underlying asset for a higher price than the option dictates it to sell it. So it's not like they are losing money, but they are not making extra money. And finally, the difference between a naked and covered positions. These are related to risk exposure, not necessarily the market volatility, but rather whether or not you know what you're doing, whether or not you know the strengths and weaknesses of your option strategy, and if you know what the worst case scenario is, how likely it is to happen, and if you can protect yourself from it. It's mostly related to short positions or positions in which we sell something that we don't currently own. When we sell a naked option, it means that we do not currently own the underlying asset. And if we are exercised in this option, if our strategy does not go as expected, we'll have to buy this underlying, whatever its market price is, and deliver to the person who purchased our options. On the other hand, when we sell cover option, it means that we currently own this underlying asset, so it doesn't matter what the price is. We have it and we can deliver to the person who exercised the option. But maybe this will incur a loss. Maybe we paid it more than the strike price we sold is. Or maybe if we sold the underlying asset directly to the open market, we would profit more from this transaction. But when we write an option and it is exercised, we have no other choice. We have to deliver what we promised. And that's it for our Options 101. Thank you very much for watching and hope you enjoyed this video and are able to learn a little bit more about how option works. See you next time. Bye bye.